Alright, this episode will dive deep into the history, present and future of the stock market. But before we dive into stocks, ETFs, futures, bank brokers or retail investors, first we should start at the beginning. Because what even is a stock? Well, believe it or not, but it all started here in my country, the Netherlands. Because, as some of you may know, my country, the Netherlands, flourished in our golden age because of worldwide trade, seafaring companies and, of course, colonization. So, for explaining all that from the beginning, I will have to take you back to the year 1602. It's the year 1602. I am in the Netherlands and the VOC has just been founded. The Verenigd Oost-Indische Compagnie, or more commonly known as the Dutch East India Company, was the first joint stock company of the world. Before this, if you wanted to profit from a trading voyage, you basically had to be the merchant, own a ship, or finance the expedition yourself. The VOC changed that. For the first time, ownership itself could be divided into small pieces and traded. You no longer had to own a ship. You could own a tiny piece of hundreds of ships. Before 1602, if you wanted to profit from a voyage to the East Indies, you'd need a ship, a crew and probably a death wish. After 1602, you could simply own a small piece of the company and let someone else sail around the world for you.
That's it?
And that idea changed finance forever. For the first time, ordinary people could own a tiny piece of a giant commercial venture. And a giant venture it became. Adjusted for modern values, the VOC remains the largest corporation in human history. Shares in the company could be purchased by any citizen of the Dutch Republic and be bought and sold in open-air secondary markets, one of which became the Amsterdam Stock Exchange. People were basically betting on ships returning from their worldwide trade endeavors in spices, exotic goods and, of course, slavery. The real innovation wasn't ships, it was ownership. If you thought Wall Street invented the first financial shenanigans, I'm afraid the Dutch got there first. Oh, and fun fact, I wonder how many of you know where Wall Street got its name from. Because at the time, New York wasn't New York yet. It was New Amsterdam. And Wall Street literally got its name from a defensive wall the Dutch built there, which is slightly less exciting than saying it got its name from Amsterdam's red light district, the Wallen. Anyway, one of the most fascinating figures of this era was a Dutch merchant called Isaac Maire. And trust me, this guy deserves an entire episode of his own. Maire was one of the VOC's founding directors and its largest initial shareholder. But after a bitter falling out with the company, it became one of his fiercest enemies. Instead of buying shares, he started betting against them. And in doing so, he became associated with one of the earliest forms of short selling, market manipulation, and stock market regulations in history. Think about that for a second. The stock market had barely been invented and people were already trying to game it. Some things never change. Maire would spend much of his life fighting the VOC monopoly, financing rival expeditions and trying to break the company's grip on global trade. Whether he was a visionary, a market manipulator or simply a very stubborn Dutchman, I'll let you decide. Because honestly, his story deserves an episode of his own. So if you're in for a Dutch golden age version of The Big Short, stay tuned for that episode. In fact, some of the expeditions he financed helped open new trade routes and contributed to the Dutch age of exploration. Just a few years later, the Dutch would establish New Amsterdam on Manhattan, before it eventually became New York. The more I learn about financial history, the more I realize something. Markets changed far less than the technology around them. The ships disappeared. The spice trade disappeared, the traders moved from Amsterdam to London and New York. But greed didn't, fear didn't, and speculation definitely didn't. 4 centuries later, we're doing exactly the same thing. Only now ships became servers and stock certificates became apps. Tulip mania became labubus. For most of history, investing was something for merchants, aristocrats and wealthy financiers. Today, anyone with a smartphone can buy Apple, Nvidia or a world index fund before they've even gotten out of bed. Where in 1602, a merchant in Amsterdam buys VOC shares, waits for months for news, relies on rumors and risks everything if a ship sinks, In 2026, a retail investor opens an app, buys an ETF, sees prices instantly, gets bombarded by finfluencers and TikTok gurus, still gets manipulated by emotions. And this is only a very recent development, if you think about it. Before, most people would invest via their bank's brokers and trust their expertise to put or bet their money on safely regarded companies, funds, or commodities. And some people still do. There's nothing wrong with that. To do your own research and effort is also an investment of precious time. And not everyone has the resources or knowledge, so outsourcing it to professionals is actually a very safe and sane choice. Because retail investing, when also susceptible for news, FOMO, market manipulation, can also get somewhat insane. There's even an entire subreddit dedicated to absurd investment bets. And when things go wrong, what they lovingly call loss porn. You might have heard of it. It's called WallStreetBets. Eventually, members of that community noticed that several hedge funds had built exceptionally large short positions against GameStop. So instead of betting against GameStop, thousands of retail investors decided to bet on it together, hoping to trigger what became known as a short squeeze, forcing those hedge funds to buy shares back at much higher prices.
Microsoft's takeover on the popular subreddit that's dedicated to markets.
It's discovered on Reddit. You can think of this similar to a sort of video game hack.
Put down a little bit of a deposit on margin, and then you get infinite leverage.
We like the stock. We like the stock. I mean, that's the kid where Ryan Cohen got in. He bought 15% at $8. He's on the board. We like the stock. And Bill Poole has no idea what it's like out there. My people have been in this game for 25 years, and they are losing their jobs, and these firms are going to go out of business, and he's nuts. They're nuts. They know nothing.
What started as a niche discussion on internet forums quickly grew into one of the largest retail investor movements in modern financial history. Millions of people suddenly found themselves debating short selling, hedge funds, and market fairness. And I think the GameStop saga shows a very interesting echo of the past here. I think the thing I want to take away here is that retail investing has some advantages and democratic elements in contrast to investing through bank brokers. The idea of choosing your own bets on which companies or materials you think have the most potential and look safe and promising on the long term is quite empowering. But it also comes with the freedom to speculate, and this can result into chaotic outcomes. What are the incentives of brokers versus retail investors? Traditionally, if you wanted to invest, you'd visit a bank or wealth manager. They would assess your goals, risk tolerance, and investment horizon and construct a portfolio on your behalf. In exchange for that expertise and convenience, they charge fees. Often, these professionals actively manage your money. They don't simply buy and hold investments. They continuously decide what to buy, what to sell, and when to do so. Ironically, many actively managed funds struggle to outperform simple index funds over long periods of time. A fee that seems insignificant today can become one of your largest expenses in your investment journey. But over the last 2 decades, something changed. Technology dramatically lowered the bar to enter the market as a retail investor. Today, opening a brokerage account can take less time than ordering a pizza. Choosing and managing your own stocks and ETFs has never been easier. What are ETFs, you ask? Instead of picking individual winners and losers, many investors simply buy a basket containing hundreds or thousands of companies at once. That's essentially what an ETF allows you to do. Rather than betting on one ship returning safely, you're basically betting on an entire fleet. So essentially, in retail investing, the advantage or disadvantage in a sense is that the trade-off is that you're now responsible for your own decisions. No fees, no advisor, no banker, no wealth manager, just you, your own research, your emotions, and the convictions that come from them. Personally, this is why I prefer retail investing. And that's not because I believe I can outsmart professional investors, and certainly not because I think everyone should manage their own portfolio, but because I enjoy understanding what I own. When I buy a company or gold and silver, I want to know why I'm buying it. That process of learning, researching, and making my own decisions is, to me, just as valuable as the investment itself. And that said, investing through banks can also offer options such as preference for green stocks or sustainable funds. So yes, there's also ways to influence your portfolio through your bank broker. And if that fits your time schedule and life directions more, that truly might be the better option for many people and could also be the better option for you. But this is what I do. The democratization of investing gave ordinary people unprecedented access to financial markets. But access and wisdom are not the same thing. And not everyone has the time or knowledge, or time to invest in acquiring the knowledge to form a steady portfolio themselves. The tools became available to everyone. The challenge is learning how to use them. Of course, every investment reflects a view of the future. Whether that future is shaped by technological innovation, demographic shifts, scarce resources, changing regulations, geopolitical developments, or something else entirely. Understanding the world around you is just as important as understanding the companies you choose to invest in, because one shapes the other. Every investment is, one way or another, a reflection of how you think the future might unfold. The stock market isn't some magic machine that just creates wealth. It's more like a mirror. It reflects innovation, optimism, fear, and occasionally pure human madness. 4 centuries ago, the Dutch discovered that ownership itself could be traded. Today, millions of people carry that same idea around in their pocket. The technology changed, the markets changed, the players changed, but one question never really changed. What do you choose to own? And why?